And because I'm sure we'll have a lot of questions today, if you wouldn't mind sharing your questions in chat, and we'll monitor that. There'll be a short question and answer session at the very end of the webinar. If we run low on time, not to worry, we will be sharing the contacts for our panelists, so you can go directly to them to ask questions that we may have missed. So with that, I'd like to introduce Val and thank her for putting this wonderful panel together.
Mahalo, Marla, and aloha, everyone. As Marla said, we're excited for our first Capital Readiness webinar. And again, mahalo to Mariko. We're very, very fortunate, as Marla said, to have her today, as well as this really distinguished panel we have here put together. So let me introduce Storm Bridgewater. He is the Commercial Banking Officer with YWCA Federal Credit Union. We also have Aaron Ellis, Director of Programs and Lending at Feed the Hunger Fund. Jeff Hildebrandt, Vice President, SBA Commercial Lending with Live Oak Bank. And last but not least, Doug Okamura, Assistant Vice President and Business Banking Officer at First Hawaiian Bank. So again, thank you everyone for your time and expertise sharing today. And let's get to the questions, Mariko.
All right. Well, part of the conversation we had during the pre-planning process was to put a human face on banking and to also bring practical, tactical advice. Like, when do you need to borrow money? How much time do you need? How do you need to be prepared? How do you go about finding a banker? And how do you make sure you're borrowing the right kind of money from the right person? So we really want to keep it focused on answering very specific questions today. And it's my great pleasure to play traffic cop and cheerleader in the questioning. So we're going to start with a softball question, guys. I'm going to ask all of you to tell us, because I think for people, we think, banking, lending, it's all the same. But each of you has a very different focus, and you have a different sort of favorite kind of clientele. So I wanted to ask you just to give a brief description of your organization and to describe your ideal borrower. Like, what do they look like your perfect borrower? And that'll help the audience know who's a good match for the kind of borrowing, the kind of financial needs that they have. So why don't we just go in alphabetical order and start with you, Storm.
Okay, yeah, so I work at a YWCA Federal Credit Union. So, we're pretty similar to a commercial bank. I think one of the main differences between, a bank and a credit union is, for us at the credit union, we're a nonprofit. So, for a for-profit bank, the profit flows through to the shareholders. And then for us, I know this is, super, generalized view of looking at it. And then for us, the profits that we have, we retain in our company. And then we pass it on to our membership in the form of, more competitive, rates, loan deposit products, and, developing our membership group. So that's basically, what we do at YWCA Federal Credit Union. As far as, type of, borrower we're looking for. So, it would be someone who is in line with our mission. And our mission basically is to, be able to service the businesses of Hawaii that are headquartered in Hawaii, that service the community of Hawaii. So that's kind of, the borrowers that we're looking for.
Okay, so super local.
Oh yeah. So and then that's by regulatory environment. So that is who we're allowed to lend to and work with.
Okay, great. How about you, Aaron?
Sure, thank you. So Feed the Hunger Fund is a community development financial institution. We are a nonprofit organization, and we are mandated to fulfill certain needs as a result of that. But from a lender's perspective, what is the ideal borrower? And not to be cute, but it is someone that will pay us back, right? That is really at the heart of it. Yeah. From a larger perspective, though, from our mission, it's really someone that cares about our community and is passionate about their business. But now our funders that are really looking for an impact in what we've stated that we're going to do, who we lend to encompasses sort of women-owned businesses, low-income borrowers, the Black, Indigenous, people of color community, the BIPOC community, And then we focus by choice, but not exclusively within the food system. So if you're a food producer, farmer, rancher, fisher, a value add producer, a retail outlet, distributor, that's sort of our core. But we do lend outside of that and within a geographic focus. And for this call, you know, it's the state of Hawaii. We also lend in California and Fresno in the Bay Area, but yeah, I think everybody here is from Hawaii. That's, you know, really us in a nutshell.
Yeah, that's great. Thank you, Aaron. How about you, Jeff?
Yes, thank you, Mariko, and a pleasure to be here. My name is Jeffrey Hildebrand with YWoC Bank. And you may not have heard of YWoC Bank, but we are the largest SBA lender in the country. So I work in Los Angeles, and I cover Hawaii from Los Angeles. In fact, I'll be out there in a couple of weeks. So if anybody wants to set up a meeting after this, we can do that live in person. YWoC Bank is headquartered in Wilmington, North Carolina, on the other side, Atlantic Ocean. So with that said, we cover all 50 states. So, you know, last year, I think we put about $1.7 billion, literally, it's not a joke, of money in the hands of business owners. So we're an FDIC bank, largest SBA lender. So that, by saying that, we have a lot of solutions that we can take a look at. But our primary focus would be small business owners. And, you know, within that segment, probably 60% of the loans we do are for business acquisitions. So we're talking about somebody who doesn't own a business, who wants to buy a business. So that's what our specialty would be. And typically we can do those with these small business administration loans, SBA for short, where they're guaranteed loans by the government. So it's easier to qualify. So typically our funding range on the basic SB 70 loan program goes from 500,000 all the way up to 5 million for most business types of, if you're on this call and looking to buy business. And frankly, like I said, we have customers in Hawaii that own businesses in California, Arizona. It just depends on the type of business if you don't need to be running it every day. But yeah, almost any business you can think about in Hawaii that's for profit, that is a operating business that you're going to operate yourself as the owner, we can typically fund those with 90% financing and 10% down under the Small Business Administration Loan, SB 7A loan program, which would be our main focus.
Great. And Doug? Last but not least, Doug.
Yeah. Hi, everyone. My name is Doug Okumura. I apologize if I sound a little soft. I'm trying to get over this. Lost my voice from a cough I had for the last 2 weeks. So if you can't hear me, just raise your hand on the Teams or any, the Zoom call, and I'd be happy to kind of address what I said. Anyway, so I'm a business banking officer here at First Hawaiian Bank locally. For a lot of you who live here or born and raised here and run your business here, you might have been aware that First Hawaiian Bank has always been the oldest and largest bank by asset size here in the state of Hawaii, founded in 1858, and we're pushing north of 26 billion in assets today. And 26 billion is a lot of money, but that's peanuts and pennies compared to your Chase and your Wells Fargo and all that stuff. But in general, I think to Mariko's question, who is our ideal bar? Well, you know, as a community bank here in Hawaii, we open our doors to everyone. First and foremost, right, we can't discriminate. We welcome everyone to apply, from personal loans to business loans, especially small business. Just want to make a side note. I'm not sure how many of you on here are a director or a chairman of a nonprofit board, but we as a for-profit bank, we can lend to nonprofit organizations as well. So if you have a 501c3 status, 501c6, whatever your tax exemption status, we've done loans and lines of credit as well to nonprofits. But I think in general, when you think small business in your mind, a lot of times you think for profit, right? Restaurant, retail, contractor, online e-commerce, business, manufacturer, etc. So yeah, we've assisted all kind of businesses before from all walks of life, different industries, different products and services. We are an FDIC insured bank. Also, you know, I think as Storm alluded to before with the differences of a bank and a credit union, we are for profit. So how that plays into when you folks come to a bank like, you know, First Hawaiian Bank, requesting for a loan or a line of credit to help grow your business, keep in mind that it is a balancing act of having a win-win situation for the bank and for the borrower, right, for the customer. So if we ever say no to you, please, by all means, we're not trying to be mean. Don't take it personal. But because we have shareholders to perform for, we have a lot of federal and state regulations we have to comply with as well. We have to make sound loans that make sense as well. So although we wish we could give money to every single person out there and every single business, unfortunately, that's not the reality. So that's what it means when for-profits have shareholders and we're looking to invest our capital in the form of a loan or a line of credit to you folks, right? So, yep, that's First Wine Bank in a nutshell. Thank you.
So that's a great segue, Doug, to my next question, which is, what is the most common mistake that you find borrowers make when they come to meet with you? Because I think that would be really useful for people to know. Like, what do you see as the number one thing where you're like, you know, I'd love to help you, but ... We don't have to go in order. If you guys have like a really good war story about, please, under any circumstances, do not do this. Tell us what that is, because we want to know. We want to know.
I think, speaking for just my own personal experience, I've been doing a lot of small business lending. We have a couple officers, at YWCA. So that's been kind of my slice I've been servicing. So I think a lot of it is just, lacking a familiarity with the process, which is, why I want to be on this webinar, because I'm hoping this is kind of, what folks can take with them is, getting more familiar with it without having to kind of go through it themselves. And I think, if I had to point at one thing, would be debt misfinance. So for us, it would just be, I think there's another question coming up, but I think it's kind of matching, the asset that wants to be, financed, with the appropriate, debt facility. So I think that's kind of a big one for me if I had to point to one specific.
Okay, so come to you with a clear need and an idea of the clear kind of loan that you would need to meet that financial need.
Right, and they don't have to. I mean, that's what we're all here for, is to help them. But if I had to point to one thing, that would be the one thing that kind of comes up over and over again.
Yeah, have a purpose.
Yep, for sure.
This is Jeff at YWomen Bank, and my take on that is, if somebody's bought a home before, that they have some, understanding of borrowing money. They bought a home, they filled in a loan application, they bought a home, they've gone through the escrow closing process, they've signed loan documents. So most of that's usually taken care of because a lot of people have that experience. But then again, I'm talking about buying a business. If somebody wants to say, hey, I want to buy a business, I want to increase my income, which is the main focus. There's only one reason to buy a business is to increase income. Obviously, have the income from that business. But so it's unlike a home where you're going to go live in the home, and homes eat money for the most part. So I think the focus is a little different, where they have to have an understanding of this cash flow. How much income is coming in from this business? What are the expenses of this business, right? When the seller leaves, how much income can I get from that seller? Because the seller takes up money. But another focus of that is how much of the salary are they expecting to take out of this business? So I mean, there's a spreadsheet involved with this, and we do this for the folks. They don't have to figure all this out. But I mean, having an understanding of what your income needs are, what are the expenses of the business, and how much can you? It's called the net adjusted income of this of this business that you want to buy. How much income is available for you to take money out for yourself and to pay the loan? So it's not just, wow, it sounds great. This business is bringing in $100,000 worth of income per year, but when it's all said and done, after you pay everything, there's all the expenses add up to $125,000. That's not going to be a good business if it's only bringing in $100,000. So having a good understanding of the cash flow and the analysis around that is would be key.
Right. So pro forma cash flow projections post.
Yeah.
So cash flow is the lifeblood of your business. I think everybody knows that, but like really knowing your cash flow is key.
You got to know your cash flow is the key.
That is important. There is also, I think, somebody who is not on mute, who's using a keyboard, and there's some background noise. So I don't know if Colleen, if you can help mute, or just to be aware of that. Erin, do you have any?
Sure. I could just add that my two things that I see are similar to that. We really don't lend based on projections. That's not to say we wouldn't look at that, but coming in and assuming that, oh, I'm going to do this thing and next year I'm going to have $1 million, we really don't lend on that. So we're looking at your current ability today to service that loan. And I think coming in knowing that, now that doesn't mean we can't do a second loan in 6 to 12 months where you do have that cash flow and you have history of that. You know, I think that's an important thing to be aware of. And also I would just add, you know, I read somewhere, or maybe it'll come up later, but you know, the timing of the need, don't come in when it's an emergency, right? Try to anticipate, understand your cash flow, when you're going to need that funding. Not that we can't lend in an emergency, but it certainly does make things more stressful for everybody. You know, trying to help in those situations.
Yeah, I think, you know, there's a credit committee. There's unfortunately, your lender is not the only one who can just open a checkbook and write a check. So there's a whole process that the bank has to go through, and that process takes time. And I think that's something that is useful for people to understand, which does segue into another question. But Doug, I know you have some good stories just from our previous conversation. So, you know, what do you think in terms of big mistakes?
I think just to sum it up, because of time too, I don't want to take up all you guys' time, because I think Jeff, Aaron, and Storm had great, awesome answers. To bring it home, just concurring and piggybacking off of them, to me, the two different aspects that any business owner should know on the top of your mind, bare minimum, right, in plain English, knowing exactly what you kind of ballpark, at least not exactly, but a close estimate of what you need to borrow, how much money you need looking to borrow, and what is it for, right? Especially if it's for a bigger project, like, oh, I got to buy real estate, a commercial property with land, or I got to do this big debt consolidation. Kind of have a breakdown at least with whether you put that on an Excel sheet or in your phone or Word document, just type it out, write it down somewhere. Kind of know in your mind, okay, I'm going to borrow $1 million. Okay, well, where's this $1 million going to go? So in the accounting world, in the cash flow world, we call this the sources and uses of funds budget or breakdown, right? So you're gonna say, okay, they're coming in to ask for $1 million, but really, what is all this money going to be used for? Where exactly is it going? There's got to be that level of accountability, because at any bank, for-profit, nonprofit, credit union, you know, nonprofit lender, at the end of the day, they're going to want to know, where is the loan going to be used for? Is it going to be used appropriately? Even if you're to approach these private investors or private lenders, or you go on the Shark Tank show, they're going to ask you the same thing. They're going to ask you, okay, you're asking for X amount of dollars. Do you have any idea what it's going to be used for? And when do you expect to pay it back, right? So, yeah, and, you know, and like Storm alluded to before, the bank will help you kind of give that guidance on appropriately structuring this. Is this going to be more of a term loan or installment loan with set payments for your budget? Or is this going to be paid back over 5 years, 10 years, 25 years? Or is this going to be a more short-term kind of line of credit, right? Paying it off in 12 months or less? Because you got to match that up with your CPA when you look at the financial statements as well. So banking and taxes and financial statements, they all kind of playing together. Not to go deep, because I know it's high level today, but yeah, there's some 2 cents on that.
Actually, again, you're serving me a perfect transitions here. Let's get like specific though. Let's get specific about, at a minimum, when you're walking in the door, right? There's like a bunch of stuff you should either have in hand or have access to, right? I can think of a few things, but I don't want to steal your thunder. So why don't we just kind of popcorn and go round robin? At a minimum, walking in the door, you need to have, take it away, Jeff.
Yeah, you need to have a personal financial statement, which you can download from the SBA website. Just type in sba.gov as the website and search for personal financial statement. So you want to have that, 3 years worth of tax returns, and an explanation of how your experience is going to translate into operating or you know, and managing the business you want to buy. So those 3 things: personal financial statement, make sure you have your 3 years worth of tax returns, and like I said, that a real good summary. Doesn't have to be a Harvard business plan of, you know, how your experience, whatever that is, translates into operating and managing the business you want to buy successfully. So not too complicated, but those are the main things we're looking for right up front.
That makes sense. If you've never owned a coffee shop before, how are you going to make sure you don't run it into the ground, right?
And you got to like coffee. If you know, that would be the first one. You got to like what you're doing.
Exactly, that's important too. How about you, Aaron? What else? What other?
Yeah, I would echo that. The only thing that I might add is, yeah, we're not necessarily looking for this super glossy business plan, just a real narrative on what you're doing, why you can do it, how you're going to execute it, some narrative, showing that you've thought about this business, where you're going to sell it, what your margins are going to be. But then adding also a year-to-date financials, your P&L and your balance sheet. We want those taxes, but we also, the taxes are always historical. So if we can have, from January through to whenever it is that you're coming in for your application, we would have current financial statements for that.
Right. If you don't have financial statements, it's very hard to have somebody lend you money. That's a minimum bar, have financial statements, right?
Yeah,
Storm,
absolutely.
anything you want to add?
Yeah, so I guess, Jeff, Aaron, not much to add there, maybe some forward-looking stuff, depending on the spirit of the request. But I guess the only thing I could add, beyond that would be, like bringing a willingness to work together. Because just like what, Doug had mentioned earlier is, what we're looking for, and I can speak for myself, and I'm pretty sure I speak for all of us, is, we're looking for a partnership, right? Where we want to work together to like the mutual, benefit of both parties. So, our institution, as well as, of course, the business. So, because every business is different, every point in time and the economic cycle is different, there's going to be like bespoke solutions to each loan. So there's going to be back and forth, and, sometimes it's very clear. Sometimes, we have to drill down farther. So, I like to think that, us as lenders, we bring a spirit of, we understand, we want to help, let's see if we can do business together. So if we could be met halfway, and then, it's a real partnership. And then the beautiful thing of that is, if it does work out, then when you folks are successful, we're happy. When we're successful, you folks are happy, and then we can work together and we can both be successful and, find some kind of, I guess, positive working relationship. So I guess that's what I would add, because they covered everything basically.
Yeah, and if I can jump in there, Storm, you're exactly right. And just to kind of add to that is, we keep all these loans, Live Oak Bank. So I mean, these are all business loans. Typically there's no real estate. Somebody's buying a business or expanding a business or whatever. But these are all business related loans. So we underwrite, process, but we also service the loan too. So we have to do everything after the fact. So this loan isn't going anywhere. So Storm's exactly right. I mean, for all the lenders on this call, this is a true partnership. So it's not like, hey, Simon Legree, the mortgagee, or the big bad banker. This has to work out for you, because the bank doesn't want the business back. The SBA doesn't want the business back. At least in our case, we do the SBA loans. The government doesn't want the business back. We want to make sure that there's plenty of income to pay the loan back. Obviously, we want to get paid, but there has to be enough money for you to make a living and put plenty of money in your pocket. Because if it isn't, then all of a sudden, 14 months later on, you're saying, why did I buy this business? Why did I borrow this money? I can't pay it back. Nobody at the bank wants that. And no lender on this call wants that either for you. So this is we're on the same side of the table here. Make sure that, the cash flow is right. Make sure the business is right for you. And everybody here doesn't work by themselves. There's a team here. So by the time it gets through processing, underwriting, credit approves it, the funder closes it, that's already, sometimes 10, 12, 14 sets of eyes that are saying, yep, this can work out. We like it. This can work out. So even that application process is worthwhile, because once you get through that much due diligence, sometimes you can say, yep, this is going to, for the most part, it can work out.
I think that's one thing that is underappreciated also going through that process, is you end up discovering a lot about your business, or you're being asked questions that you may not have thought of. It also makes you, I think, a better steward of your business, having to be forced to look at it through bankers' eyes. But this is something that I do want to emphasize. I think there can be this idea that the bankers are, a big authority figure, the big no, and instead of looking at it in a partnership, because you guys don't want to lend money to somebody whose business is not sustainable. You're not doing that person any favors, and you're not doing your bottom line or your mission. You're not upholding your mission when you do that. And the same way that you guys also need to have things that work, that instead of looking at it from like a supplicant and a, doomsaying, no-saying person, that you're really looking at it in partnership, which also means that you as a borrower, need to take ownership of what you need, and the responsibility of that. You're really looked at as a partner peer. And I think sometimes this can feel very intimidating, this gap, which is partly why we're doing this webinar, is to kind of put a human face on banking. And if you have a legit business need, and you have a legit business, which means that it's profitable and is sustainable, or you have a very compelling path to profitability, then we're good. Sometimes the answer may be you're not ready just yet. And all of you want to be able to lend money to people who are your right fit. And the not just yet just means that there are places you can go to get there, like the Y, or your banker might say, you know what, why don't you hire, a better accounting firm and straighten out your numbers and then come back and see us. So I just want to say that explicitly, because I think that that's something that can be lost when I talk to people around debt and borrowing money, is this sense of a power gap, say, as opposed to it being a partnership. So having said that, I will then ask you that, there's the old joke that bankers only want to lend you money when you don't need it, right? I do think Valerie touched on it too, that sometimes you want to be borrowing money when you may not actually need it yet, because there may be a business opportunity that comes up and the window is very small, right? But if you already have a relationship, you already have your numbers, right? You can move fairly quickly, because banks do have this credit vetting process that can take time. So lining up your credit, even if you don't need it right now, can be actually a really great business insurance. It allows you more flexibility, more options, all of that stuff. So I wanted to ask you all on the panel, when is a good time to come to you? And if you don't need to borrow money, but you're going to need to, but you want to have a credit line, you're going to pay fees for having that available. Do you need to use it and pay it down, use it and pay it down to keep the line alive? How do you keep, if you're a business owner with the great privilege of not needing to borrow money right now, but you want to keep your options open, what's the ideal setup for you? And, or, when do you feel, how much, if there's a time horizon, you think, ask us 3 months before you need it, 6 months before you think you need it. Just if you could share your thoughts about that, because that's something that I think a lot of business owners would love to know. Like, when do I start this conversation? Because it could take a while.
Well, I can talk about the business acquisition aspect of it. So if you're a business owner looking to expand by buying another business, that could be one business acquisition idea. Or if you're just an individual and you're looking to buy your first or second or third business, whatever it is, there's two pieces of that puzzle to get the loan approved eventually. Is the guarantor, the individuals, and then the target business. So if you don't have a target business right now, the business you want to buy, we can definitely work on the first piece of it, is getting you pre-approved as an eligible and qualified SBA borrower. So we can do that, run your credit, all these things. So that takes care of half the work that's already done. Once that's completed and we have you pre-approved, so to speak, we can issue a one-page pre-approval that you are qualified and SBA eligible borrower up to a certain amount. Later on, that amount's really going to be determined by the seller's tax returns. At least that's enough to to be able to put a letter of intent or a purchase agreement in to either the broker or the seller themselves and say, hey, I'm ready to go. I'm already approved by the largest SB lender in the country, Live Oak Bank, as an SB borrower, and I'm interested in your business. Then you'll be able to get the seller's tax returns and their financial statements, and then we can fill in the other half of the piece. But yeah, I mean, I would say if you are looking to do that, you can do that right now, because all the questions on the forms we have as a personal guarantor. So half the work is done, and then you can just take your time. Whether it's there's only 2 months left in this year, early next year, at least you're in the running to do something. By taking that first step is the key.
Mm-hmm. Absolutely. Doug, Aaron, Storm, hop in.
I would just say, whenever you have an identified need, is the right time. Don't wait until you're in a cash crunch. You know, you see a lot of startups just running everything off their credit card, which I get, but if you can anticipate that you're going to need that cash beforehand, you know, come and talk to a lender. If you've got to buy some piece of equipment that's, you know, a 9-month lead time to get out here, you know, you're going to need to figure that out sooner than later. The time process, I did see that question come up, and I would like to address that. It does depend, but I would say give yourself, you know, 3 to 6 weeks at Feed the Hunger Fund, you know, from your completed application to cash in your account.
That's great. That's really fast. How about you, Storm or Doug? Me.
So for us, I think, you know, Aaron and Jeff have, you know, pretty much covered all, you know, the basics of the question. I think there was a second part of the question that was, if you have a line of credit or a credit facility, you know, is it worth like showing usage, you know, even if you technically, you know, you don't need the capital. So for us at YWCA, and you know, I would assume every shop is different, but for us, you know, there's no need to, you know, draw on the line, you know, pay it back just to show that there's usage and, you know, the business is handling the debt facility. For us, you know, our lines of credit are really for short-term working capital purposes. And, you know, every business, you know, they don't want to pay interest if they don't have to. And then, you know, it's not you know, there's no reason for us to get those, you know, few days of, you know, accrued interest on the line, just to show that, you know, it's being used. I know on the personal side, I think, you know, on the, you know, personal credit bureau reports, there's some value there in, you know, showing usage. But for us, you know, if we already have a facility in place, to, you know, one of Jeff's earlier points is, you know, we already have an established relationship, we're servicing it, you know, we're reviewing it, we're watching it, you know, so, you know, just to answer that question point blank, for us, no, there is no need to, you know, show usage on a business line of credit, just to show usage.
Okay. But you do want obviously to pay, there are some fees that you have to pay to keep that line of credit.
Right. So there'll be like an annual fee. You know, every institution is different. You know, some can waive depending on, you know, relationship or, you know, any number of other factors. So, you know, is it worth having it? You know, that would be you know, a decision that each business would have to make on their own. But, you know, for us, what that shows is, you know, if there's no usage, it shows, you know, everything is being financed from internal cash reserves, you know, the profits are being retained, or, you know, equity is being injected, skin is in the game. And that would give us comfort actually as a lender that, you know, the company is being run pretty prudently on the financial side.
Yeah, that's great. And Doug, do you have any comments? Any other thoughts?
Yeah, so I think to kind of bring that home, bare minimum with
You're the guy
most
bringing it
industry.
home all the time, Doug.
Yeah,
Sorry.
I think I totally agree with what Aaron, Storm, and Jeff was saying. And at the end of the day, regardless of your industry, or even if you're a nonprofit, I think majority of industries and small businesses can have or should apply for some degree of a business line of credit, like preferably unsecured, of course, and then a business credit card. Also, you want to check with your institution on this, whether it be your First Hawaiian, Hawaii USA, or whatever bank or credit union you guys currently bank at. Because one question that gets overlooked is, will that business line of credit or business term loan or business credit card, that business credit product, is it going to be reporting on the business owner's personal credit? Here at First Hawaiian Bank, it does not. So we do have to do a one-time hard pull on the business owner's personal Equifax score. So we only touch, and again, even that is different by bank to bank, lender to lender. Some lenders only pull from Experience, some lenders pull from TransUnion. We only pull from Equifax. It's a one-time hard inquiry, so very minimal impact to your personal credit. If approved for any kind of business loan or line of credit product, it will. I can assure you, it's not going to show up on your personal credits. So in other words, even if you're using the credit card or the line of credit property for inventory, for supplies, for material and all that, to kind of fund your carrying costs of your receivables and your inventory, especially even if you're paying it off month to month, if that shows up on your personal credit with any random bank or lender out there, that could start to hurt your personal credit score. So you don't want that, right? Because your personal life is separate from your business life. Always keep your personal income and expenses separate from your business income and expenses. So yeah, so in a nutshell, yeah, it doesn't hurt to have a line of credit and a credit card ready to go, even if you don't need it. To the point, like Storm was saying, you don't really need to use it. Why pay interest if you don't have to? Now, kind of teeing up though on a longer term scale, if you know in the future your goal is to apply for a bigger loan line of credit, you're trying to grow, you're trying to scale, you're trying to expand, and you want to show that history with the bank, it doesn't hurt to do that. And at least from a short term perspective, if you're trying to hire employees, that's a good reason to use the line of credit. You're trying to buy more inventory for the holidays, that's another reason why you want to use the line of credit, right? Sure, you might pay some interest month to month a little bit. So what, you're going to get a tax deduction on your what you call on your profit and loss. You're going to show the interest cost. You can't write off principal payback on the line of credit or the loan, but the IRS will let you write off the interest cost if you're for-profit business, right? So it's one of those things where depending on what your goals are, you may or may not want to use it, right? So yeah.
All right, no, that's great. That's super specific tactical advice, which I really appreciate. So let's talk about this. Let's talk about personal guarantees. Like, what is it? And some borrowers really are violently allergic to the idea of using personal guarantees, of providing a personal guarantee. But a lot of business loans are hard to secure without them. So can we just take a minute just so that if people are surprised, like, oh, they show up and like, oh, wait, I need a personal guarantee. So can somebody do like the Twitter version, or excuse me, the X version of what a personal guarantee is, and sort of explain that take on it, just so that people understand when they should expect to have that request made?
Yeah, Marico, I can take a whack at that because I get that a lot here at First Hawaiian, and it's I'm sure the other lenders here can attest to the fact that it can be a sensitive topic. It can be a very personal topic, and it can be a very misunderstood topic and concept, right? A personal guarantee, the Twitter version, the short answer is at the end of the day to the bank, it's just a secondary source of repayment, and on AKA it's another alternative source of cash flow that's going to pay back the debt if your business can't pay it back. So what does that mean? Okay, say your LLC or a corporation applies for this loan or line of credit. Oh, okay, you're stuck. You're in a conundrum. You're either going through a worst case bankruptcy or you're defaulting on this loan, which we never want, right? But let's just say there's a certain season you're operating at a loss, they can't pay it back, and you're kind of just temporarily for now losing some funds and losing some money. Well, you as the business owner with your strong character, if you stand behind, you believe in your business, that's your baby, that's your bread and butter, you got to keep this afloat for multiple reasons. So you might take money out of your personal savings, your personal checking, or maybe you have other source of income coming to your household. Maybe your spouse has a day job or military income or rental income or another business. So whatever it takes, right? Whatever it takes to keep your business going, you're going to take money out of your personal pocket or that's coming from the business owner. That's what it's going to do to fund the loan in that season where your business can't pay that back. Now, as far as I think I saw a question somewhere on there, as far as when do you sign one, when are you not allowed to sign one, what if the business owner doesn't want to sign one? On a simple basis, from any for-profit business, majority of the banks here in Hawaii, sorry to say, they're going to have the same credit policy. It's a risk management decision with all the banks. For 51% of all business owners that have 20% or more of equity ownership in an LLC, corporation entity, you have to sign a personal guarantee. You stand behind that business, right? And that shows character. Character is saying, hey, I believe in my business. Someone took the risk to start this business. If it was that easy, the whole world would be starting a business, right? And if it's a nonprofit organization, a church or 501c3 nonprofit, the banks and lenders cannot require a personal guarantee. However, on that note, that we can't require personal guarantees for nonprofits, we are going to expect, the banks are going to look at the financials and expect it to be a lot stronger with the operating cash flow and the financials of the business, right? So, yeah, I just wanted to touch on that for the personal guarantee concept.
Right. Anybody else?
Yeah, I can talk about the SBA aspect of it. So, the Small Business Administration is a government agency. It's all based in Washington, D.C. So everything I'm talking about is regulated by the government, and it applies to all 50 states and any applicant. So it doesn't make a difference whether you're in Hawaii, California, New York, Florida. It's all the same. No discrimination. It's an even playing field for everybody. But some of the big issues there is the personal guarantee. So how these are usually structured is if you're going to be buying a business, or if you own a business and you want to buy another business, for example. So your entity would be the applicant, the borrower. So if you have a C corporation or an LLC or some type of legal entity, or if you create a new one, that would be the applicant, the borrower. So these SBA loans are true business loans because it's a loan not to you individually, but to your entity and that EIN number that you'll create or that you already have. So it is a true business loan in that aspect where it just becomes business credit. And these aren't, at least Live Oak Bank, we don't report these to a personal credit report, right? But the guarantee comes in is that whoever owns more than 20% or more of that entity, that borrowing entity, must and is required to be the personal guarantor. So if you have a husband and wife team, you're going to be buying this business together, you're going to operate it. Both of you will be the individual guarantors. Maybe one of the spouse is going to operate, and the spouse says, "I don't want to have anything to do with that." Then you can have a limited guarantor to the spouse. So, there is flexibility in that. But number one, for SBA, 20% or more ownership, you have to be a personal guarantor. But it's kind of a moot point. Let's say you borrow $1 million to buy a business and you say, I'm not going to pay the money back. Even if you didn't a personal guarantee it, they're going to still come to the business. You're the business owner. So there's legal obligations still there, even if you don't do personal guarantee. But regardless of that, SBA requires personal guarantee. So anywhere in the whole 50 states, if you want to get an SBA loan, you have to be a personal guarantor.
Okay. So it's sort of hard to avoid, it sounds like. Yes?
Unless you know the senator and they can get that removed from your loan application.
Right.
Because these are all man-made laws, right? I mean, Donald Trump became president. The corporate tax rate used to be 33%. Now it's 21%. I'm not a fan of anybody, but I'm just saying they're all just man-made laws, right?
Funny how that happens. All right. So one of the things that we touched on very briefly, but I think there are different kinds of loans, different kinds of credit available for different applications. So without getting too much in the weeds, but just could you all talk about how you think about matching a business owner's need for capital to the type of loan, like, because you guys are doing match.com, capitalmatch.com, right? So what are you trying to match there?
So for me, just real quickly, super high level, I know we don't have much time, is, I guess the easy way to think about it is to think about what asset, you would want to finance. So for us, we have a business line of credit, it's a 1-year term. So it's for short-term use. So, either is, to finance, inventory, which would be, a short-term asset, or, accounts receivable, which would be, a short-term asset. So we're financing, the timing gap, to collect AR. So, what we're going to be repaid with, in that case, is AR. So we're matching it up with, a short-term debt facility. Whereas maybe like a piece of equipment, maybe, it fully depreciates in 5 years. Let's say there's a 5-year useful life. So maybe we would match it up with a 5-year term loan, just to your point, making the match.com kind of, strategy. And then, for real estate, we do an appraisal. Let's say there's 25 years of useful life remaining. Then we could go out maybe 25, up to 25 years, on our loan term. So that's just, really roughly, big picture is kind of how we think about it at Hawaii USA.
You want to match the time horizons, the asset liability matching on time.
Yep.
And then there's collateral and uncollateralized loans too, right? Secured and unsecured. So if you have asset-based lending versus not.
Mm-mm.
Anybody want to weigh in on any of those things? Just
Well,
because
go ahead.
I need to think about how, what kind of capital, like what structure should I go after? Because that also will tell me which banker I should approach, right?
Yeah. So a Live Oak Bank is primarily a cash flow lender. So you don't need collateral literally to buy a business. So that's a fallacy. Hey, you have to own real estate to get an SB loan. We do many loans to people who don't own real estate that are buying a business because, like I said, we're pretty much a cash flow lender. And then the other piece of that would be the character. So we're, the chairman of Live Oak Bank, and you can read about him, been around for a long time, like 50 years in banking. His name is Chip Mahan. But from the top down, there's two. Forgetting about numbers, there's two basic sentences that we, kind of live by here as lenders, and I'm a loan officer at the bank here, lender. is one is the eye of the tiger. So when you're working with an applicant, do they have the eye of the tiger? Can they operate this business? Can they handle problems as a grown adult? Will they talk to us during tough times? So that's so important, because you got to just deal with reality and face tough times. And when you do face the tough times, they're never even as bad as they are when you in your own mind, when you face it and say, wow, that wasn't even too bad. But that's a key concept here at the bank that they talk about all the time. Okay, Jeff, did they have the eye of the tiger? Can they, okay, cash flow's not great. There's no collateral. We can do it still because we get a guarantee from the government. And then the other one, and this goes to us really, is treating every customer like the only customer. So every lender treats everybody like that. We meet, we talk in person, we do Zoom meetings, to get to know the customer. Because the more that we can get to know up front, the better presentation we can make on something called our credit memorandum that the credit team uses to approve these loans. So if you can make a real strong presentation on those two things, is hey, I care about this, I'm all in, I can handle problems. Here's why my experience comes together for this loan for this business. Is and I'm on credit committee calls, so with small loans and even large ones, it comes down to that sometimes, and they approve the loan. They approve the loans on these. And like I said, the proof is in the pudding. Last year, 1.7 billion funded, almost 1.8 billion of SBA loans. That's a lot, and every number isn't perfect to get that much done.
And I think that that's an important thing, is that you all, as as a customer facing person, you're an internal advocate, you're the salesman for your borrower to your credit committee, because they're like the Dr. No of the bank, right? So that's that personal rapport is really important to the eye of the tiger. I see you, I believe you're going to do what it takes to make this happen. So, which is actually a perfect lead into our one of our last questions, which is kind of what's the best way? Because to develop a relationship with one of you, because you're all busy, right? And we can be kind of shy. We have our businesses, but how do we, how do we, like, now that we feel more comfortable that you actually want to lend money to us, that's awesome. But how do we, how do we take that first step on Match.com?
Just reach out. It's really that simple to start the conversation. And like you stated, I totally view myself as an advocate for the applicant, the loan applicant, right? We're there at the loan committee to get that yes. And I think the more tools that you give us to do that on your behalf, this makes it more likely to get the loan. So yeah, email, call, text, whatever it is, just start it. There's no reason not to.
But let's just get real, right? I mean, you're going to get a ton of emails, you're going to need 10 of calls, right? So I guess I could say, hey, you were on this webinar, and Aaron, like, okay, I know, I'm a farmer. I know that this is kind of your sweet spot. So I'm going to reach out to you, not to Jeff, because I'm not trying to buy a business. I grow kalo, right? But I mean, like, how that's still a lot. Like, you got to be able to be good at a cold email to be able to say, hey, Aaron, I don't know, maybe I grow 100 pounds of kalo a week. I don't know, and maybe I need to get a tractor, and, is this something, I mean, like, do you need specifics, or will you just even like do coffee?
I think it's just starting, we've been great. We've been growing. We've done great last few years, and I've got staff now, so it's not just me. We've got a presence on the Big Island, and we've got 2 other folks here on Oahu, where, we're looking at Maui and other places. Just reach out, set up a call. We can have a quick call. We can send somebody out. We love to do site visits. We love to tell our borrower stories. That's huge. We are grant funded, so our funders want to hear your stories. That's our success story. So really, just begin a dialogue. And it may not be me, it may be Alama, it may be Natalie, and maybe it's Eric, but it's going to be somebody here on the team that will want to talk to you and hear from you.
That's great. And how about you, Storm?
So for us, it's pretty easy. So, just call me, text me, email me. And, no matter, I mean, we're all busy. So I know you folks are busy too. So just send me a call, like send me an email, call, text, and we can go from there.
You guys are really nice, you know that?
Well, if it's an unknown number, it's definitely going straight to voicemail, but I'll listen to it.
Like, you'll take my call, you read my email. Wow, you guys are too nice. Okay, how about you, Jeff?
Yeah, I mean, email me. I'll put my email in the chat, or I think you can send our emails up. But if you email me, I'm going to respond with an SB funding request form, which has these basic questions on it. You know, what are you looking funds for? How much do you need? A few basic, questions about yourself and your background. A couple of preliminary questions about qualifying. So that gives enough that we can set up a phone call or a Zoom meeting. Just like I love doing the Zoom meetings that we can do face to face. So we can set up a Zoom meeting. So if and again, I'm just talking about my work ethic and ours. If somebody doesn't want to fill that form in, they're not too excited because this is, I mean, they know all the questions on this. Is all about you. These aren't tricky questions. So if you're not going to do that, there's not too much interest. But at least if you're filling that in, no cost obligation, that'll start the process with that. But if there's hesitation to fill that in, whenever you're ready, fill that form in, and then we can get you down the road.
Okay, fair. How about you, Doug?
I think yeah, same call, text, email, but I think I want to say, and just a side note, even if you start off with an email saying, "Hey Doug, I saw you on the Zoom call. I'd love to pick your brain. I think I have a funding request for a loan or line of credit I want to do, or I'm looking to buy this asset or this equipment or this real estate." I think at the end of the day, it's the easiest and quickest ways to first start off with at least a simple phone conversation. And the reason why is because there's sometimes that there might be certain loans or lines of credit the bank or the lender just can't do, right? It might be totally out of our scope. It might not be within our risk appetite. So if we could just dive right into it, you kind of tell us what you're looking for. I can tell you, just to save you guys time, save us time. So especially there's no frustration. And I think Jeff, Aaron, and Storm, besides myself, if we can't help you with a certain loan or line of credit or funding request, right? We'll at least do our best to point you in the right direction. Hey, check out this lender, check out this hard money lender, check out this gap financer, whatever, check out this private finance, right? Well, we might point you back. We might even point you back to Marla and Mariko and Val and the team, right? And we might say, hey, go back to these are great resources to leverage. Go back to them, circle back with them, say, hey, I checked with First One Bank, they couldn't do the loan line of credit for this reason. Maybe let's change our game plan. Let's change our goals a little bit. Let's modify it, right? So just because you hear a no at one point, or a project or an investment that you thought was a realistic goal is not a realistic goal at this time, it's not to say you can't pivot, right? So yeah, so a simple phone call might help, and say, hey, yeah, if we can do it, let's just talk deeper, then we'll schedule an appointment. Let's dive deeper into it and start talking about what you need. So yeah.
Awesome. That's great. Well, you guys are great. And we have a couple minutes left. So I'm going to ask Marla or Valerie. I know there have been some questions posted in chat. If you guys could serve up maybe the most compelling ones. And then we can maybe also follow up in an email. And maybe we can address people's, because I see there's a lot of comments in the chat. So a lot of questions.
Yeah, thank you so much for all the information and all of your links and offer of help. We did have a handful of beginners here, startups, early stage businesses. What is their approach to access to capital with you, or in general as a new business?
Yeah, I get that question a lot, right? Because we'll tell somebody, well, we don't lend based on your projections. Like that's all I have. So we would look at additional household income, or an additional guarantor. Is there a third party that's willing to co-sign, or do you have additional household income? A lot of times, maybe somebody's got a day job and they're starting up the side gig and they're trying to grow that. And so we would look at your day job income there. I know it's not the answer a lot of people want to hear, but I think that's the reality for us.
Yeah, it's hard to do credit risk assessment on vaporware, basically, yeah.
Mariko, if I might chime in a little bit, just looking out for you guys, for any of the businesses that have been around or have less than 3 years history of the business, right? To define a startup, depending on what kind of entity or agency you're going to look at out there, is different definitions, right? So to the IRS, they look at startup from all the startup costs till your first sale, right? From a tax deduction standpoint. For a lot of the local banks, we look at startup businesses as you've been in operation less than 3 years, because you have less than 3 years of tax returns and financials. Like Aaron just said, you would have to have projections at that point as part of your, hopefully you have a business plan. If not, I'd really encourage you to create a business plan so you can, everything's in your mind, but put it on paper so you can kind of see that and show to either investors or to a bank, because you're going to raise capital through debt or equity. And both is cash, but equity, you come from giving away your equity ownership to an investor, or debt by raising debt through a bank or lender, right, to borrow money. Now, the quicker and easier way is if you can partner with family, friends, business partners, and just use your own cash to get started with what you need, especially if it's a smaller amount. It just makes life so much simpler, less frustration. You won't have to worry about, oh man, I'm trying with this bank, get this bank, I'm getting turned down left and right. So if you can self-fund, as much as possible, try to leverage personal credit cards, personal loans for now. If you own real estate on your own, a home equity line of credit or a home equity loan, cash out, refinance, 30-year fixed mortgage, and then keep track of all the personal debt you're using from accounting and tax perspective. And then as you grow and you exceed that 3-year mark of showing some track record with your profit and loss, your balance sheet, your tax returns, then you're ready to come in for some true business loans and lines of credit. Then yeah, let's look at that. And if you still have personal debt that you use to fund your business, hey, look, yeah, we can use as part of the loan to take out that or consolidate that personal debt because it was really for business purpose, right? There's no rule that says you can't use personal debt to fund a business. Just be careful. You don't want to use business loans to fund personal debt or personal needs. Kind of a big no-no to the IRS, right? So yeah, just throwing it out there.
The other thing I would add of unsolicited advice, if you are going to borrow money from family and friends, paper the loans, make it as professional as possible and really clear what the terms are, because it's just pretend like they're your bankers and have that same level of it's just cleaner if everybody realizes that they could lose everything. How much you owe them and on what payment plans and all of that. So the clearer everything is up front, the less opportunity for misunderstandings, and you don't want to have to blow up your family and friend relationships if you can help it. So
Mariko, this is Jeff at Live Oak Bank. I got to jump off, unfortunately, and I put my contact information in the chat.
Thank you, Jeff, so much.
Thank you,
Appreciate
Jeff.
it.
Hey, great to be here. Thanks. Good seeing everybody. Bye-bye.
Great. So we're a couple minutes over time.
Yeah, so we should probably wind it up and answer to everyone's busy schedules. And I really appreciate, again, all our panelists taking the time and sharing their expertise and providing some exposure for businesses big and small here. And also for being so generous as to put your contact information in the chat. We'll respond to everyone who registered with their contact information. Here it is up on the screen, but we'll also make sure we get it to you on email. And then, as Doug said, check in with us if you find that you're not quite ready, that you need additional help to organize yourself to be ready. That's what the YWCA Business Program is here for. Mariko in particular, helping with our accelerator. And we're looking forward to hearing from you and on to the next Access to Capital webinar. This will be a series that we'll continue with. And hopefully we'll dig into some of your other questions if they weren't answered today. So thank you so much, everyone. Thank you, Mariko and Val, for organizing this. And we will see you again in the near future. Take care. Have a great week.
Thank you all. Aloha.
Thank you, everybody.
Thank you, everyone. Take care, guys.
Thank you.
Take care, everyone.